Hi, I'm Elizabeth, and I'm a financial advisor and financial planner. Most of my clients do come to me with one huge question. How do I invest? In fact, it was one of the major questions that I had when I wanted to get into the field of investment management and financial advising. And the truth is, most people are already invested. If you participate in a work plan or you have some amount of savings, those are investments. So let's talk about a little bit more about what an investment is and how an investment review goes when you work with a financial professional. I am a fiduciary fee-only financial planner. That's a little bit different than working with someone who doesn't have the same certified financial planning license that I have. They might be looking for what's called suitability, not looking from the lens of a fiduciary, meaning I have to advise investments based on the best recommendation available to the client, not the particular best investment I can sell them, which is suitability. So fiduciary, it's a higher standard. Fee only means the fee we express and agree on is what you pay only. I do not get commissions from selling anything. Bigger video content there, but let's get into it. What's an investment review of a household with financial advisor look like? This is a single individual who has just retired, and he actually came to me stating, I think I'm overly invested in stocks, which by the time you retire, something around 50-60% in stocks or equities is probably a good position to be in, and the rest in fixed income, which is like bonds, maybe US treasuries, maybe high yielding cash, some various other tools and techniques. It's probably an oversimplification, but just so you know what we do. I mean, what does it even mean to be invested? All right, so let's share the screen. I want to do something different this time. Hold on. There it is. Okay. Yeah, that's what I want. Okay. All right, Zoom screen. Let's go. So how do we start here? We start here. This is a snapshot from our financial planning software tool. I'm not sharing. Desktop. Does that work? I don't know. Hopefully this is recording. We'll see. Okay, technical difficulties. We got it. All right, so this is an example from our financial planning software for this client. We have them integrate 100% of their accounts. Now, we can have them use Yodlee, aggregator tool that puts all of their investments as a read-only format securely in our software. That's good because if you have any changes in your account, it updates automatically. It's really nice. I don't have to have access. You set that up, you authenticate, and you re-authenticate because it is requiring re-authentication, meaning signing back in over and over again every, I don't know, 2 weeks to 3 months. And I don't indefinitely have access, to see what's in your accounts. It shows me the account value and it shows me the ticker symbols or the actual investments in the account. That's good because then I'm able to get the asset classes that those ticker symbols or positions represent. Because asset classes function differently. They perform differently in the stock market, and they don't always perform in the same way. So you want a nice, healthy mix for your risk level. These are big terms, but bear with me here. If this is you, you have a handful of accounts and you could list those out. And you also would need to know all the positions underneath. But for most people who are just invested in their workplace 401k and maybe some cash savings, it's pretty easy. I have a cash position and savings here, and I have this one target date fund. I can roughly Google what the asset mix or asset category mix is for this ticker symbol in my 401k plan. You can start to get an idea. Oh, it says US large cap is 25%, mid cap is this, international is that. And you can start to get a sense of where you're at. It gets complicated, and that's, I think, the value of working with a financial advisor. All of this is doable. It's just the tools that we have make it a lot more accessible. So we have a work plan, we have 2 IRAs, they're traditional pre-tax IRAs, we have a savings account, and we have some cash and CDs. And I only put the total asset value. I blocked out everything else because this is a real life example. So we have all the data that we need. And if the client, in this case, they didn't want to link their accounts, they could provide me with statements and we securely share those over, and I can manually input all of the different ticker symbols and asset classes. Sounds like a lot, but we're paid well. There's no reason why I shouldn't be doing this. All right, so then I'm able to generate this report. So in order to understand how you're invested and how to invest, I think it's important to know that you need to have a good picture of 100% all of your accounts that are investments. It's really difficult and a challenge to allocate the same in one account and then the next account and then the next account. There are reasons why you want to know your total picture for all accounts, particularly if you're married or have multiple people in a same household, because you may not have to make changes. One account can be more aggressive than the other. That's okay. We're really looking at the total picture, where there are gaps and where the next best in dollar is invested. So we need to know 100% of all the investment accounts. And then we need to know your asset categories so that we can say, okay, you have invested this much in large cap value stocks, et cetera, et cetera. And you need the third thing, which is risk assessment. You need to know how much risk you can take on, because then that determines your current portfolio and how that may or may not differ from a target portfolio, right? So just like in budgeting, it's helpful to know where you stand. This is where this client stands. So I've done this enough to know, this is a relatively a touch riskier than necessary. I know other factors in this client's account and lifestyle. They have a pension, they have Social Security. Those are very safer forms of income sources. He does not need additional income except for the extras in life. So he's actually not that heavily invested, provided we take into account that grouping of CDs in the one account that he has. There's some approximation that we do in terms of how to categorize assets by asset classes, but for the most part, we're not too far off here, in my opinion. And in the context of the big scheme of life and how your success in life works with investments, a change in performance, so this is an average annual return of 6.5%. This is an average annual return of 7.65%, but it's riskier. So it could be less several years when you need it. I think it's important to know that this is all contextualized. Changing 1 percentage point or half a percentage point improvement or lowered performance projected out in your portfolio, it's not going to swing your results too much. And that's why you have to really put investments in its right category in your life. They're important, but not sufficient to reach your goals. Your investment mix, how do you invest? Better spent time on your cash flow, keeping expenses below your means, investigating ways to increase your income sources. Those are probably going to take you a lot further, as well as saving more annually every single year, provided in retirement accounts, maybe elsewhere. These are going to be much more important tools to your success, especially earlier on in your life and career, than to belabor your investments. Now, if you're 50 years old and you have hundreds of thousands in cash, there may be reasons for that, but that might be a red flag to start investing and focusing your efforts there. So let's contextualize investments here. They're only as important as they are relative to all the other aspects of financial planning, including, the B word, budgeting. And I have tons of videos on budgeting if you want to see more. And if you want to see more, make sure you like and subscribe and watch another video, because we have great commentary on how to budget and assess cash flow. Okay, so we have all the household's investments, the accounts. We have all the underlying investments categorized by asset class. And that gets tricky. That's why financial advising has these tools. We know is a bit riskier based on the risk assessment, which is how much risk could you tolerate? And there are questionnaires you can take for that. And I would highly suggest everyone taking a risk questionnaire online if you can find one before you start understanding, what's risk. Now, If you're watching this in your 20s, you're like, oh, that's pretty low. I could get X amount percent in crypto this year. That's fine. There are lots of different investment types and classes and categories, et cetera, et cetera. I have a bias for investment management. That's why I'm looking at the S&P 500 over a 30-year stretch of time. So I'm looking at average annual returns. Sure, 1 year at 20% return is probably included in this and this. But 2 years at negative performance, maybe -5, is what establishes an average, right? You need several years over and over again of a consistent mix of asset classes and a portfolio over 30 years to get an average annual rate of return. So that's what we're talking about here. Yes, some years much higher, some years less. I also have a conservative bias, which means I would rather a client invest only as risky as is necessary to adequately provide for their financial goals. If they want to, if they have a higher risk capacity and risk tolerance, so they want to be riskier and they can tolerate being riskier, then we can look at that. But you'll find that the results overall for this client's goals, it's not too swingy when we get more aggressive. So why take the risk? That's where something called standard deviation comes into play. Don't worry about that for this one. Again, watch some other videos. Leave a comment if you want to hear more about standard deviation. I don't want everyone to fall asleep here. So we need all investments. We need all the investment ticker symbols and underlying asset categories, and we need a risk assessment. And that's how we come up with this. But what does this tell me? This tells me, there could be some improvement in some longer term or differentiation in the fixed income or bond space. It also tells me mid-cap is underrepresented. It tells me that large cap is overrepresented, which is typical of most portfolios. Small cap, also overrepresented, and international, underrepresented. So do I go and tell this client, okay, in each of your accounts, sell this and buy that? It's not that easy. One account is a retirement account, another account's another kind of retirement account, and another account is a cash CD account. It's in a cash CD account at a bank, you can't start buying investments in there. So how does this all work together? And that's where we copy the chart of all their investments, and I reconfigure this chart so where it says assign how to use, and I start listing out the bullet points. You expressed a discontent with this account's administrator. Feelings matter. This is a great account to consider rolling over out of the 403B plan, since he's retired, into one of his 2 IRAs. So that would also determine which IRA do you like better. It doesn't have to be 1-for-1. You could roll it out first into one, then make a call. Or you can consolidate the 2 IRAs and then put the 403B in. When you roll over a work plan like a 403B or 401k, almost always, though there are exceptions, they send you a full cash rollover check that you deposit. Therefore, whatever this account is invested in, when you roll it over, will be completely eligible as cash. Then we can reallocate. We can do some more US large cap, growth and value, and we can do mid cap at that point. And we can do a little less, but a little less in small cap. We have some guidelines on how we might be looking at this. We could do a little bit more on the fixed income side outside of short-term fixed income. All right, the next one you might notice is the same recommendations as the other one. It's hard to see this because I wanted to block out the data here, but these are 2 traditional IRAs. So it's an opportunity to consolidate. Consolidation is important because it's easier. You can see if you have 20 accounts versus 2, it's much harder to say, what's my allocation mix? What's my mix by asset class? So the fewer accounts you have, the easier that is. The fewer statements you have, the fewer items you have to report on your tax return. When it comes time, now it's age 73, of when the IRS forces you to take money out of pre-tax accounts, like a 403B or traditional IRA, you will have fewer what's called required minimum distributions to calculate and distribute from your accounts. Nobody's going to do this for you. Your custodian or wherever your account is held might proactively do it for you. But if we could take 3 accounts into one, it's largely simplified. There's also just a tremendous amount more flexibility with an IRA, both where you can invest and what you can do with it. For instance, instead of a required minimum distribution, you can use that to give to charity. Not going to belabor that point. If you want to see a video on that, leave a comment so I know, and I can build that out for you. So we've assessed all the different positions at this point, right? I look at expense ratios. I look at consolidating. I look at some other offerings that might be interesting that are only available to us as advisors, etc. So 2 IRAs consolidate to 1. When you roll over IRAs, usually those positions can be maintained. It's not like a 401k or 403b where they issue a cash check. They actually take whatever positions are in here and just in kind roll it over. It's not a taxable event if it gets into the IRA appropriately. So it's a rollover process. This is not advice, by the way. You have to consult your own situation and your own custodians and own processes for these. But I wanted to say that this is, educational at best. So 2 IRAs that can be consolidated. Also, because my fees matter and I'm a fiduciary, I said, hey, one of these we can manage. One of these you can manage. Keep the 2 IRAs. We'll take over one. You keep the other. You decide where your 403b wants to go, and we can see how it goes. This way you get ongoing financial planning with me. And in the future, we can make a call on how we might want to consolidate because he still has a little bit of time before he's 73. All right. So now we have a savings account. We talked about how cash can be interpreted. You want 12 months in retirement, a single household, 6 months of expenses is probably sufficient. I'm suggesting 12 in the earlier years of retirement to avoid sequence of returns risk. If you want to hear more about sequence of return risk, leave a comment so I know. Like and subscribe. I'd love to provide that content for you as well. All right, so we're going to roll this 403b over. That's going to give us more opportunities to invest. All the IRA investments are fine. So with the new 403b money, let's focus on some of those gaps. A little bit more of large cap US because we might miss out on that when we roll it over. Certainly more in mid cap and a little bit more in small cap because we want to make that mix better. Also some international. That's going to be important. Of the fixed income, we can take a look. I don't like the bond index funds personally. I normally recommend index funds, but we can talk about that later. So this would be an opportunity if I manage the accounts. The account I manage are probably going to be heavier weighted in fixed income because we can offer an actively managed or individually choosing bonds that can live in his account rather than a bond index fund. So maybe the outside account is more aggressive for that reason. So this is why you can't look at one single account and say, this is how I'm invested. So the savings account, emergency funds, here's the target. Anything above the emergency funds, and we do in this 2024 want to be making 4% or better in savings on that, is best put into investments. And so there's this CD fund, that would be great. This is a great opportunity. I'd say let's just leave that as is, and we're going to invest around it. But this is another opportunity where the next best dollar can be invested as well. So surprisingly, not as aggressive as he had thought. We do have our fees here. And then we actually provide a suggested allocation. So if I was looking at, the gaps, right? Okay, let's say I didn't make any changes to the accounts. I'm going to sell some of my large cap and put it into mid cap. And so we give them this. Okay, well, let's see. What do we have here? Where's the mid cap? Mid cap, Vanguard mid cap, VO, perfect opportunity. I'm going to pick up some of that. And what do we have in international? I mean, I know emerging markets international, but VEA. Okay, maybe I'll pick up some of that too. So those would be the key areas, right? The next best dollar, provided it's coming from large cap, selling a little bit of US large cap, would be in VO and in VEA. As this isn't specific advice, this might not be exactly what I do. I have software that helps me determine all of these calculations for me. I even have software that assesses where the next best dollar can be invested. It's called rebalancing software that does exactly what I did with the math and showed you here by asset class. And it goes ahead and suggests the actual buys and trades to make it more balanced and match this pie chart under allocation chart here. So this is exactly what I produce for every client for an investments review. I look at their existing investments across all accounts, all spouses. Then I make sure that I know 100% of what those underlying investments are. If I don't, I make some assumptions and they're incredibly conservative. Then I properly categorize all of those underlying investments so I can determine what their current portfolio is invested in by asset class. Then I overlap that with a risk assessment. It's a questionnaire, it's a tool that tells me how risky or how invested in equities we might be. And then I get a comparison. Here's how you're invested today. Here's how you likely would benefit from being invested in tomorrow. Then it's not so easy if there's several accounts. So I give a bulleted line by line document that expressly states the considerations for each of these accounts. If I can work with a client and we have a couple of financial planning meetings, usually we do 3 to 6. If we have a couple of those and in this case, we already know this client's Social Security situation and Medicare situation, I don't have to belabor that in our content together in our meetings. So I can take a meeting and say, let's start doing some of this together. Let's call your 403B plan and issue the rollover check, and let's deposit it into the account together. I can use my time there. If I don't, it's because we're dealing with the larger, more impactful issues in their financial plan. Because again, investments is just it's in its own box in your total financial life. Important, but not sufficient for reaching your financial goals. And then we usher in the conversation when the financial plan is complete. Here's the action items. You go ahead and do this. If you want, you're fully enabled. If you are not, come back to me. We do assess a management fee. It's less than most. And we can get these financial planning meetings and we can start executing on this, and we can take over management of your accounts and start investing appropriately. So you know someone's watching this. And there's so many reasons beyond just returns, because that's not at all what anybody should be promising you in my space. Nobody should promise you returns. So that's investment management. Like and subscribe. Let me know what else you want to see.